How does correlation impact your investment strategy? Imagine trying to build a puzzle with pieces that fit perfectly together. That's what understanding correlation is like for your investment portfolio. It shows how different assets move in relation to each other. When assets are highly correlated, they tend to go up or down together. For example, stocks in the same industry often rise and fall in sync, which can increase your portfolio's overall ups and downs. If you only hold assets that move together, your risk can grow because losses in one area might be amplified by others moving the same way. On the other hand, assets with low or negative correlation tend to move independently or in opposite directions. Think of stocks and bonds. When stocks drop, bonds might stay steady or even go up. Combining these assets helps reduce the overall risk because losses in one can be offset by gains or stability in another. This is a core idea in modern portfolio theory, which aims to find the best balance between risk and reward. When you diversify with assets that don't move together, your portfolio becomes more resilient during market swings. For example, including commodities or real estate alongside stocks can help smooth out performance because these assets often respond differently to economic changes. If the stock market dips, your real estate investments might stay steady or grow, providing a cushion. But remember, correlation isn't fixed. It changes over time based on economic conditions, inflation, or market trends. For instance, stocks and bonds can switch from moving in opposite directions to moving together, especially during periods of high inflation or financial crises. That's why it's important to review and rebalance your investments regularly to keep your diversification effective. Relying solely on assets with low correlation isn't enough either. Combining multiple low-correlated assets or strategies can give you better protection. This approach is like having different layers of defense in your investment plan. While low or negative correlation can lower short-term risk, it doesn't guarantee long-term gains. So, correlation should be one of several factors you consider when shaping your investment strategy. In the end, understanding how assets move in relation to each other helps you build a portfolio that balances risk and potential reward. It's a key part of asset allocation principles and specialized wealth strategies, helping you stay steady through market ups and downs. Mastering correlation means you can make smarter choices, creating a more stable and effective investment plan that aligns with your financial goals.